Pleased to welcome on my finance and business special today, Chintan Haria, Head of Product Development and Strategy at ICICI Prudential Mutual Fund. Hi, how are you, Chintan? I hope your family and you are safe and healthy and that you've got your jabs, your vaccines.
No, we managed to catch the virus about a month and a half back, so our vaccine will have to wait for about a month. But thankfully, with God's grace, nothing, no major damage. So we are fine. Thank you, Rishi.
I'm happy to see you healthy and doing well. Now, everybody's going to ask you this, and it's important because what we're seeing with the equity markets is unprecedented. What is your take on equity markets currently, Chintan?
So the longer term take on equity markets is always more important than the shorter term take, and the longer term take is very simple. If you and I both believe, and every listener of yours believes that India is a country where demand for all goods and services is going to go up, courtesy our growing population, courtesy our growing wealth, then obviously as an equity market, what is equity markets? Equity markets is a sum total representation of whatever is the goods and services which are being bought by each one of us. So if you believe that's going to go up, then yes, equity markets in the long run will reflect that. In the short run, of course, there are many factors which impact equity markets, which we can discuss later as well. But long run, as far as India is concerned, if we are going to move from a $3 trillion economy to a $5 trillion economy, that will get reflected in the goods and services and the equity markets and the companies which are listed on the exchange. So it is for us to participate in that. Historically, we've been lesser as Indians in participating in equities, but I think courtesy your channel and courtesy the growing awareness, especially among the youngsters, more importantly on what is the right way to invest and remain invested in equities, is helping India increase its percentage allocation towards equity, which is good for the long-term wealth creation as a nation.
Well, despite the advent of business channels and know-how, uh, I'd like you to actually indulge me in some spoon feeding because it's really important to get the basics right. What really is, Chintan, a flexicap fund?
Yeah, sure. So there are various categories of mutual funds, right? Large cap, mid cap, small cap, dynamic asset allocation, multi cap fund, large and mid cap. They are all well defined in terms of what they can do and what they can't. Similarly, the flexicap category was introduced about, I think, late last year, and it is essentially a very simple category. Flexicap funds in the mutual fund category are those funds which can invest across large cap, mid cap, small cap, meaning the entire spectrum of available listed universe they can invest in, and there is no restriction of any kind on either sector or stock. They can also invest a certain portion if the SID or if the objectives allow in international markets, in REITs. So it's a very wide spectrum. And so from a fund management perspective, it's a fund which can do very well for investors if the fund manager manages it well across the spectrum and through the market cycles. And as an investor, of course, we believe that this category should be there in every investor's equity allocation for the long term. And that is why not surprising that as a category today, it has the largest assets under management in the mutual fund industry, one of the largest.
Your team sent me a very interesting card, an analogy, likening it to cricket, which is our national passion. Test cricket, ODI cricket, and T20 cricket. And how you can draw from all three formats to actually create the best. Are you a cricket fan yourself?
Crazy, crazy about cricket. So journey started right after I think Sunil Gavaskar retired. So I'm a original Sachin fan, and then now moving to from Mahi
Lovely.
to now Virat. So I mean, I've lived cricket, played cricket since the last what since I can think and remember. Every single day, even today, if there's a test match, I watch it patiently whenever I can, of course. And yeah, I do follow cricket like a religion.
What do you think of a second string team going to Sri Lanka, considering the main team is in England? So it'll be very interesting for all of us cricket fans because you've got the Test cricket format going there, the ODI and the T20 format going there. And do you think Shikhar's boys will do as well as Virat's boys?
So the beauty of the talent in India has been brought out very well by the I think the Indian Premier League, and the kind of players that we've seen across formats have been phenomenal. And most of the young generation or the newer people, especially if you look at the entire test in Brisbane, which
Beautiful.
something which will be etched in my memory, much like the 2001
The
Calcutta
GABA.
test. It was basically the youngsters who did the job for us. And where did the youngsters come from? It was all, I think, the grind of IPL, playing with the best players, which taught them. They did not get overwhelmed even playing in Brisbane in Australia. And they won us that series at least. It's unbelievable. So I think both. In fact, India can have 3 teams or 4 teams as well, and they will do well. And that series in Australia taught us the importance of bench strength and the kind of bench strength that we have. No matter 7 injuries, we still went and won the Test series. I can't forget that.
For all you non-cricket fans, the GABA at Brisbane is the final frontier for all Australians. They never lost there till the Indian team gave them a lesson to remember. We're going to come back to the ICICI Prudential flexicap fund. Chintan Haria is Head of Product Development and Strategy at ICICI Prudential Mutual Fund. So it's newly launched. Many congratulations. How's it different from other equity mutual fund categories? And what do you pride yourself on at ICICI Prudential Mutual Fund?
So, Rishi, if you see, for example, today, people have money. People have saved money because they've not traveled in the last 1 year or so. People have saved the money because probably, they've not spent on going out and eating, etc. No matter how little or large that money may be, it is important to learn the importance of investing. And that's where we believe that there is money to be invested. People don't know how to invest and how much to invest and where to invest. And that's where we felt that from a timing perspective, launching the ICICI Prudential FlexiCap NFO right now would be a right opportunity for investors to start investing their investing journey or increase their equity investments. What makes it different and unique? There are 2 things which I would like to highlight here. First is it being an NFO. When we collect the money right now, somewhere in mid-July, we will be investing it over the next maybe few months. We will not invest it in one go because markets can give us opportunities as well. And so those investors who are fearing, okay, markets have rallied too much. Do I invest everything today? We are taking the onus of probably, investing over a period of time, next few months, and getting the right set of stocks for you. The second is essentially, like I mentioned, it can invest in large, mid, and small. But what typically happens, Rishi, is that when the mid cap, small caps do well, everyone wants to run that way. When the mid cap, small caps do badly, people run away. So now, even manager, it is very difficult to be flexible in large, mid, and small, and increase your mid and small cap investments because the smaller companies can have bigger swings. And so, if you have a model-based approach, a very simple model which can tell us that based on the current valuations, based on the representations of the large, mid, and small, you should be so much in large cap, Y in mid cap, and X in small cap. So you have the proportions defined by the model, and if the fund manager has to then follow that model in a disciplined manner, that will also add a lot to the long-term benefit to the investor, because when the markets are cheap on the mid and small cap, you will have a larger allocation that the model will say. So I think with this smart allocation, the fund investor will definitely benefit, is what we believe in the long run. And hence these two put together, plus the fact that markets are where they are. So investors looking at currently investing and increasing their investments, this becomes a good choice for them to shortlist and look at from an investing perspective.
You actually segued very beautifully into what was going to be my next question, because I'm very intrigued by your in-house model. Is this the same one, more or less, that you use for your Balanced Advantage fund? And what are the principles of that in-house model that has proved to be so successful? Give us an insight into that, Chintan.
So our in-house valuation model, which is the price to book model for the Balanced Advantage fund, which you have spoken about, I think I firmly believe that all investors, if they are looking to start their journey or increase the equity investments, they should start with the Balanced Advantage fund category. And as far as our model is concerned, which you mentioned, it is again a very simple model wherein the valuations of the market determine how much of your money should be in equity and how much of your money should be in debt. Just by way of example, if I have to explain, in March 2020, when the pandemic struck and the markets fell a lot, the Balanced Advantage fund, increased its investment from, I think, 47% to 77% in that pandemic period, in that fall, which is very difficult to do, right? How many of us were able to increase equity allocation? But because the model told us to do so, we did it. And similarly, currently, if you see, as the markets have gone up, the model has told us reduce equity, and the equity is somewhere around the 40% range. So the model per se is a very simple model. The valuations on price to book of the market tell us how much should be in equity and debt. That's the equity and debt allocation model that we have. The large, mid, and small cap model, which we call it the market cap model, it's again based on the relative valuation of large cap, mid cap, small cap. So these two are different models meant for two different funds. And we believe that if they are simple models and can be applied with discipline, the investors ultimately benefit. And for us, if investors benefit, we would be happy. That's our whole job. Thank you.
And given the current market condition, you think it is a perfect fit? This category is most relevant given what's happening right now.
Correct. So we firmly believe that with the broad basing of the market, right? If you look at it all around you, the demand for goods and services is going up because we have a younger population. The working class in India is increasing. Our GDP per capita is probably just about $2,500 or so and is increasing. And whenever a country has seen that $2,500 mark and is increasing, it has seen an exponential growth in its demand for goods and services. So a large variety of sectors available in India. India is not a country where there's only one sector which is large. We have a healthcare sector which is large. We have an auto sector which is large. We are, I think, fourth or fifth largest. We are the largest outsourcers in information technology. I think in steel production, we are the second largest in the world. In banking sector is also very large. So we have so many sectors to choose from, so many stocks to choose from within those sectors, and hence even the smaller companies, because entrepreneurial spirit in India, you just need to see the number of unicorns which are coming out and you'll know the entrepreneurial spirit in India. It is not surprising that India is that ecosystem of entrepreneurs, and that's where a flexicap fund will fit in well, because it will allow investors to participate across the market spectrum in large cap, mid cap, small cap, as well as across the sectors. And if the fund manager picks the right 35 to 40 stocks approximately, it will do the job for the investors while keeping risk in mind. The job of the fund manager is also to keep the risk in mind. It is very easy to pick up the stocks which are doing well, and then, when the market cycle turns, you really don't know which are the good and the bad ones. But the fund manager's core job is to ensure that the risk is also kept in place. And hence, for those investors who do not necessarily have the time to follow the markets, we would say that invest your long-term equity money into the ICICI Prudential FlexiCap Fund and basically allow your investments to grow. And with time, the power of compounding will eventually kick in, and you can possibly reap the benefits for all the tasks or objectives which you have, thought of for yourself in the future.
Chintan, I want to get into some specifics. What is the ideal investment horizon for a scheme like this, for the ICICI Prudential FlexiCap Fund?
I would say if you're investing in equity, the ideal investment horizon is forever. Keep on remaining invested and it will compound and it will compound and it will compound. Difficult to do because you hear so much, you see so much, and you try to time. That's something which needs to be avoided. Specific to the FlexiCap Fund, if I have to a minimum time horizon, while I already mentioned there's no maximum. Anything in equity, if you're investing, and if you're investing less than 3 years, it will be probably not worth taking that risk, because within 3 years, anything can happen in equities. We've seen that in the last 15, 18 months, the sharp fall, the sharp increase, you can get caught on the wrong side. Give it minimum 3 months, and the longer you keep, the better it will get, because equity markets in the long run tend to reflect the economy and the economic growth, which none of us doubts that India is going to grow. But in the short run, there are so many factors which can affect the economy. Tomorrow, America falls or American markets fall because of some reason. FIs pull out money from India, foreigners pull out money from India. Even if India does not have a problem, we will see markets fall, and then you'll get scared, and then all the problems. So hence, don't have a horizon less than 3 years. Ideally, have a horizon more than 3 years, and invest only that part of your money which you are sure you'll not need for at least 3 to 5 years, and remain invested and keep investing. And more importantly, Hrishi, I think, and for today's generation, this becomes very important. Many youngsters would be listening. Saving as a virtue in India was the most important virtue taught to us by generations. In India and China, this is taught as a virtue. It's not so much in the West. But I think we are probably forgetting about it. So when I see people spending a bomb on, let's say, a mobile phone or something, I feel that maybe you can save some from there, maybe buy a slightly cheaper phone, but start investing, because ultimately if you start investing now, you're probably able to afford a better phone some years down the line, and also you would have learned the investment journey. So start early is what I would say. Start saving early, start investing early. You will make mistakes, you learn from them, but ultimately objective is that make your money work for you and create your wealth.
Chintan, the investment universe that you're going to be drawing from, the benchmark index, I'd like you to tell people about that.
So the benchmark index effectively will be the diversified index of 500 stocks, I would believe, because this can invest across sectors and stocks, and it is a diversified index benchmark which is there. And from a fund management perspective, why is the benchmark important? Because the fund manager will have a look at the benchmark and see what are the sectors which are there in the benchmark and what are the weightages of those sectors, and try and probably keep a check or keep it in mind when he's curating the portfolio, when the fund manager is curating the portfolio. Because ultimately, as an investor, if he can have the representation of the right sectors, and within those sectors, the stocks which have, let's say, 3 to 5 year earnings growth, good management quality, and also where the management is taking care of all the stakeholders, not just the shareholders. It's taking care of the employees, taking care of the distributor, the people who they buy from, and also the people who the entire environment as well. I think the sustainability of investing is also very important. If a management is taking care of all of that, that fits in well. So from a fund management perspective, this flexicap fund provides that opportunity, which is very good across the market cap, and the benchmark acts as a guide to the fund manager to achieve that objective.
The investment approach itself, is it going to be a top-down approach, a bottom-up approach? I'd like you to dwell on that a little bit, please.
Correct. So I'm sure investors are dumbfounded by now. What is top-down? What is bottom-up? I'll try and first demystify what is top-down and bottom-up, and then probably answer the question. Because these jargons they come very easily to you and me, but I'm sure all investors may not understand.
True. Yeah.
So top-down investing is a method of investing. So there is top-down, bottom-up, value, growth, and X, Y, Z. But let's stick to top-down and bottom-up for this discussion. Top-down approach in terms of investing is that you basically decide, okay, where is the market cycle right now? Where are the macros? India as a country is going to grow, and globally liquidity is strong, liquidity is easy, interest rates are low, so equity markets will do well. So that's, you decided at the top end. Within the top-down approach, now once you decided liquidity is strong, you want to be then in the sectors which will benefit most from those. So you decide the sectors and then you go to the stocks. That's the top-down approach in very simple terms. Bottom-up approach is that I really don't care what's happening in the world. I really don't care what's happening across sectors. I look at stock by stock and see the next 5 years potential for this stock, the business in which this stock is the management quality is good. Does this business have the balance sheet strength to keep on growing without diluting the equity? Again, of course, I'm using some jargons, diluting equity growth, but essentially without needing more money, can this business keep generating profits and grow on its own? Then basically your the value to the shareholder and you as an investor will be that much more in that business. So the bottom-up approach is you ignore what's happening in the industries, countries, economies globally, but you focus on that particular company and see whether that company is doing the right thing in the sector in which it is, whether it has growth potential, and you invest in that company, irrespective of what's happening around you. So that's bottom-up investing. It is company-specific. Top-down investing, I would say, is macro or high-level thinking, and then, filtering into the company. So top-down starts from the macros or the country level. Bottom-up starts from the company itself.
How you launched the healthcare ETF. There was also a pharma, healthcare, and diagnostics fund. And obviously, you remain bullish in the healthcare sector. I mean, that is something that we've seen in this pandemic that one needs to do. So just as a small aside, I'd like you to dwell on that away from our FlexiCap discussion.
I think much like how our technology sector is the biggest global outsourcing, our medicine or our pharma companies are also the largest global outsourcers of medicine. Indian medicine or pharma companies through the last 15-20 years have developed strong capabilities to export to even the difficult countries like US where getting approvals is very tough. And the larger names in India over the last 5-7 years have again proven that they are able to capture a large part of the market. In the last 1 year or so, in the last 1.5 years, we've seen the pandemic bring out certain opportunities within that as well. There were certain raw materials which we were importing from our neighboring countries or other countries, which now probably Indian companies will ramp up capacity. So, healthcare as a sector, as we all know, for the last 25 years has been growing in India, and it is not surprising if our population is going to grow from current 130 crore people or 134 crore people to 150 crore people. We will need more medicines. Plus, with the advent of medical insurance, with the advent of even the government schemes, Ayushman Bharat, etc., the access to medicines has increased exponentially. Plus, a large part of the Indian, let's say tier 2, tier 3, even the villages, the access to doctors has increased. And so obviously the right medicine being prescribed and the availability of medicine has also increased. As the companies have become bigger, their distribution networks have become bigger, so they're able to reach out to more number of people. So on the one hand, more number of people. On the second hand, they have more money in their hands, either through the government schemes or of their own, because India is growing. And third, the companies themselves are basically able to reach out because they are becoming bigger and bigger. So healthcare sector, if you ask me, we can't live without it, and the pandemic has taught us that. Over the next 5 years, 10 years, 15, FMCG companies with soaps, detergents, etc., will, or maybe toothpaste, etc., will see growth in India in line with the growth in the population. Pharma will also be required in that way, and be it diagnostics, healthcare companies, hospitals, and the medicine providers, that is the pharma companies. I think the future is bright, but again, there you should have a 5-year, 10-year horizon. Don't immediately expect that in 1 year you want to make big money. That's not what you should be doing. So when you're allocating to pharma, think of it as a 10-year, 20-year participation in India's medical story unraveling itself. And I think at the end of 15, 20 years, you will find yourself in good shape in terms of your wealth created in the sector.
Valuable advice, very lucidly explained there by you, Chintan. So let's wrap up. For people who tuned in late, caught this a little late, the newly launched ICICI Prudential Flexicap Fund. Why should one invest in a flexicap scheme? Just a summation before we say bye.
Sure. So, in summary, if you look at it, India as a country is on a growth path. Among the larger countries, we are the fastest growing economy, and from 3 trillion to 5 trillion, if you have to move from an economy perspective, a wide variety of sectors and stocks will participate. And hence, as an investor, you should be invested in a flexicap fund because it allows the fund manager an unconstrained mandate to invest across large cap, mid cap, small cap, across all stocks and sectors. And as India grows, if the fund manager picks the right stocks and sectors, you will get the benefit out of it. What we are bringing on the table as a differentiating factor is that for the first time, we'll be bringing in a model-based approach towards selection, how much of your money should go into large cap, mid cap, and small cap, which we believe through our experience of managing models in a simple manner and a more disciplined manner of investing through model, we will be able to provide you with the large, mid, and small cap allocation through cycles, which will ultimately help you generate better risk-adjusted returns. And it being the market the way it is right now, and many people are fearful to invest today because markets have gone up, we are going to be investing in this fund in a staggered manner over the next few months. So from an investing perspective also, you give us the money today, but we will be investing in a staggered manner, picking up the right stocks and sectors as they provide the opportunities. So we believe that this ICICI Prudential FlexiCap Fund should be a part of your portfolio for the long-term horizon. Do not invest in equities for the short term, but keep it for as long as you can, and you'll see the power of compounding kicking in, and the FlexiCap Fund helping you in your journey of wealth creation. Thank you.
Just a wonderful conversation with Chintan Haria, Head of Product Development and Strategy at ICICI Prudential Mutual Fund. And I'm sure a lot of your cobwebs or your queries were removed there. Well, thank you very much for this. And let's hope that we send the good vibrations to our cricketers in England as well as Sri Lanka. And the next time you and me catch up, we can talk about how we won both those series. Chintan.
Yeah.
Super. Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.